Hi everyone, welcome to a brand new episode. I'm Marcus. Today we're looking at Alibaba. We'll cover the income statement, balance sheet, cash flow, key figures, our key feature, and technical analysis. This episode you sure don't want to miss. Is Alibaba worth buying? Let's find out. As I mentioned, we're looking at Alibaba, and they are traded on New York Stock Exchange and are in the trade and service sector. If you go down to the screen, we can see that their market capitalization is at $360 billion and their revenue is at $814 billion, which is bigger than their market capitalizations. Now, the PE ratio is at 18. I like it because I like companies with a PE ratio of 20 or below, so that is a major plus. Now the profit margin is at 15%. I like it because I like companies with a profit margin of 15% or higher. So having 15.3, that's on the threshold. Now the price to sales ratio is at 0.44. Normally I like companies with a price to sales ratio of maximum 4. So having 0.44, I like it. So that is a goal for me. Price to book value is at 2.3. 2.2. I like companies with a price to book value of maximum 3. So having a 2.2, I like it. So that is a plus. So if we summarize, the PE ratio is within the range, price to sales ratio also within the range, and the price to book value also within the range. So that tells me that Alibaba is undervalued. Now they don't pay out any dividend, which is a shame because I like those recurrent income. And the return on equity basically tells you about a company's ability to create return on their equity. It is very critical that you have a company that is able to create a return on the capital you about investing in them, especially when they don't pay out any dividends. So having 11%, which is a bit low compared to what we have normally been looking at, but it's still positive. I like it. Return on assets is at 4%. I like it. Now, the stock is currently traded at $128 per share. If we go down to the moving average, we can see that we are below the 50-day moving average, but also below the 200-day moving average. This tells me that their stock price will continue to decline. So if we take a quick glance on the chart, we can see that we have been moving in a negative trend channel. But we'll take a closer look at the technical aspect further down. But let's jump over to the income statement, and what we can see here is that the total revenue went from $158 billion up to $717 billion, and the numbers have been growing steadily every year. I like it. Now gross profit went from 98 billion up to 296 billion, and also the number have been improving every year. I like it. Net income went from $43.7 billion up to $150 billion, and also the number have had a positive development over the past 5 years. I like it. Now let's jump over to the balance sheet, and what we're interested in here is that the current assets versus the current liabilities, and we can see there is a huge difference between the current assets and the current liabilities. Basically, if the company were to convert their current assets to cash, they are able to pay off their current liabilities, which is positive. I like it. But they are also able to pay off their current liabilities, which is amazing, which is huge. I like it. Now imagine being able to pay off your mortgage, your student loan, your car loan, everything, and still have capital left on the table. That is just amazing. I like it. Now if we were to look at the total liabilities, we went from 185 billion up to 615 billion, and the numbers have been growing steadily every year. That is a minus. I would like to see them start reducing their total liabilities because it's growing rapidly, which is concerning. Now let's jump over to the outstanding share. We went from 2.6 billion shares up to 2.7, a difference of 100 million shares over the past 5 years, which is not huge, but still negative, because what happens when a company issuing shares is that your share of the company is being diluted, it's decreasing, and a lot of investors either skip this part or doesn't know about it, but they'll be looking at the income, the balance sheet, and see the company having a lot of assets and the debt's not growing that much, which is great, which is positive. But on the other hand, company issuing a lot of shares shares, and that's a way for a company to bring in more capital without taking on more debt. So seeing that Alibaba is issuing shares, that is a minus. Now let's jump over to the cash flow. What we are interested here is that the operating cash flow versus the capital expenditure, and we can see in 2021 we landed at 231 billion and the capital expenditure at 43 billion, a difference of 188 billion. Now we can see that the operating cash flow have grown steadily every year for the last 5 years, which is plus. I like it. The capital expenditure went from 17 billion up to 43 billion. Also the numbers have grown. We fell off for the last 2 years, but overall trend is positive. I like it. I like to see companies invest in their business, so that is a plus. Now let's jump over to the key figures. What we can see here is that the earnings per share went from $16.9 per share up to $54 per share, and the number have been growing steadily every year. I like it. Now revenue per share went from $61 per share up to $261, and the numbers have been growing steadily over the past 5 years. That is a plus. Equity per share went from $108 per share up to $341, and also seen a positive development over the past 5 years. That is a plus. Now they don't pay out a dividend, as I said, which is a shame because I like those recurring income, and also when I see that the income is growing every year, which is a shame that they don't pay out any dividends. Gross margin went from 62% down to 41%, and the numbers have been falling every year. That is a minus. I would like to see them become more efficient. As we can tell by reading this, is that the cost of the goods sold is increasing. Imagine in 2021 a gross margin of 41%. That basically tells you that for every dollar that they bring in, more than 59% goes to cost of goods sold. So they need to find ways to become more efficient. So that is a minus. Operating margins went from 37% down to 23%. We grew 1 year, but then for the last 3 years we've seen lower and lower numbers, which is negative. So that is not good at all. Profit margin went from 27% down to 20%, and also the numbers have been decreasing every year. We grew 1 year, but overall trend is negative. That is a minus. Return on equity, as I mentioned, tells you about a company's ability to create return, and you want to have a company with a positive return on equity, because then you know that they are able to create return on the capital you're about to invest in them. So seeing that they went from 15.6% up to 16%, when the numbers have been growing steadily every year. We fell off in 2021, but overall trend is positive. I like it. Return on assets went from 8.6% up to 8.9%, and also we grew for the last year, but we fell in 2021. Overall trend is positive. I like it. Solidity tells you about a company's financial strength for the long term, and they went from 55% up to 55.4%, and also the number have been growing. We fell off here and stagnated, and then we grew, then we fell off a year. A fluctuation, but if you look at it, a positive development, so that is a plus. Balance sheet liquidity, same thing as solidity, but here it looks at the company's financial strength for the short term, and we went from 1.9 up to 2.7, and also we fell off a year, then we grew again. So we fell off 1 year, but overall trend has been positive. I like it. Debt ratio went from 0.67 down to 0.66, and also we numbers grew 1 year, but have for the last 3 years decreased. So that is a plus. Basically in 2021 they had 0.66. That means that the company had 0.66 times more debt than equity, and seeing that the numbers are decreasing, that is a plus. Now guys, we have gone through the income statement, balance sheet, cash flow, the key figures. Now over to our key feature, which is the pillars. And what the pillar does, it gives you a simplified, holistic overview of the company's performance. If you want to dig through the numbers, you can dig through the numbers, or have the software do the heavy lifting for you. If you go down to the screen again, we can see that the PE ratio is below 20, which is plus. They don't pay out any dividend, which is negative, and the number of outstanding shares have increased, which is negative, and revenue increased over the past 5 years, that is a plus. Profit margin above 15% plus. Profit increased over the past 5 years, that is a plus. Current assets is greater than current liabilities, plus. And solidity increased over the past 5 years, plus. Balance sheet liquidity increased over the past 5 years, plus. And debt equity ratio decreased over the past 5 years, that is a plus. And total liabilities have grown for the last 5 years, that is negative. Guys, as you can tell, it gives you a simplified, holistic overview of the company's performance, and it saves you a lot of time. If you want to dig through the numbers, you can dig through the numbers or have the software do the heavy lifting for you. You can have everything we've gone through, plus the software, plus access to the discussion forum where you'll be able to chat with me along with other members for only $10 per month. So make sure to jump over to commerce.se and become a member today. All right, now let's jump over to the technical aspect of the stock. So here we have the chart. As you guys can see that we have been moving in a negative trend channel over the past few months, and we can see that the price broke down below the channel and formed a double bottom formation. And I believe a lot of investors were, when they saw this formation, were waiting for the price to move higher in order to enter the trade. But we need to be very cautious here, because as you can tell on the support line now being a resistance line, that we've been here before, and it has held its position. So there is a good chance that we might not see the stock break above the resistance level to go back into the channel. And we can also see that we are currently within a negative ascending triangle, and we might see price continue to move down here. And I think actually if that the company is undervalued, there's a huge potential here. And looking at the stock price development, this has nothing to do with the performance of the company, because if we were about performance of the company, the stock price would be much higher. This must be political. So when you look at the company's performance, sure, there is something to be very aware of, that the gross margin is falling, the profit margin is also falling, and the operating margin is also falling. So that is a warning flags that they need to improve those areas. Also, the debt is growing very rapidly. It's sure at the current state they are able to pay off the total liabilities, but continuing this path, that would look very different soon. So they need to start reducing their total liabilities, improve their operating margins, profit margin and gross margin, and that would be a signal that there is a huge potential here. But overall, the company is undervalued, so there is a huge potential here. As I mentioned, they're seeing the stock price decline has to be political and nothing to do with the company's performance. So there's a huge buying opportunity here. So I'm thinking actually about taking a closer look at the company, maybe even enter for a trade. How would you trade the stock? Please let me know in the comment section, and I hope you enjoyed this episode. And please give me a thumbs up, comment, subscribe, and let me know what stock you want me to take a look at. Until next time, guys, take care. Bye-bye.